Welcome, everybody. Welcome to today's event. I'm Sam Hewlett, the moderator for our panel discussing the future of venture capital going into 2025. Just a quick bit about my background. I'm a former founder, now active angel investor in LP. I help run the LP Institute, which offers education, deal flow, and community to emerging limited partners. So if you're interested in learning more about that, you can check us out at govclab.com/LP Institute. Quick word on format today. Our panel is going to run for about 30, 40 minutes. And then we'll follow that up with 15, 20 minutes of Q&A. So as you're kind of listening to the panelists, if you've got burning questions, feel free to start populating questions into the Q&A. And we'll get to those and try and keep that as interactive as we can. Just a quick disclaimer as well. The content presented today is not directed to any investors or potential investors, and it does not constitute an offer to sell or a solicitation to buy any securities. Said differently, none of this is investment advice. So now we're going to get into introductions for our panelists. Today we are joined by Robert Pedullo, as well as Giuseppe Folorani. And I'd like to ask our panelists to just briefly introduce themselves, give a little context on their background, and then we'll hop into things. Giuseppe, maybe we could start with you.
Sure. Thanks for the intro, Sam. Hello, everyone. My name is Giuseppe. I'm Italian. I'm based in New York. I've always worked in venture investing and entrepreneurship, primarily with business angel groups and startup accelerators in Italy, in Hong Kong, and then more recently in the United States. And currently, I'm the managing partner of High Tides, which is a pre-seed venture firm, and we focus on migrant entrepreneurs in the US. So thanks for having me. I'm looking forward to this discussion.
Terrific. And Robert?
Hello, everyone. I'm Robert Pedullo, based in Vero Beach, which is 80 minutes north of West Palm Beach on Florida's Treasure Coast. I'm the managing partner of Treasure Coast Ventures, a VC firm propelling early-stage technology and healthcare innovators to build remarkable companies that have a positive effect on the world. A graduate of Harvard with a doctorate in business from Oxford, I'm an ex-McKinsey consultant and multiple exit investor. I've served on the investment committee for Keiretsu Capital and as a tech and business advisor to K2X Capital. I'm a four-time entrepreneur, accelerator mentor, and advisor to 100+ startups, known for PhD-level board, valuation, and exit strategy expertise. I think I bring a unique blend of intellectual rigor and practical experience in all aspects of business, having literally sat on all sides of the startup investor table.
Amazing. Well, I think everybody can see that we've got two panelists with exceptional experience. So I'm pretty excited to get into this and hear their perspective on where things are headed. So maybe Robert, we could start with you. I'd like to start with getting a sense of if you could share a moment or experience that ignited your journey into the world of venture investing.
Sure. For me, it's been a very natural, gradual progression. I've been an entrepreneur much of my life since elementary school. Most recently, my wife and I launched an online program called Startup Smart Kids that teaches personal finance and entrepreneurship. For the past 6+ years, I've been a full-time professional investor in startups, as well as a senior advisor and board member. As I previously mentioned in my intro, I've served on the investment committee and the advisory board for 2 different angel venture capital firms. I've judged hundreds of startups in pitch contests. Another factor that led me into venture capital is that people kept asking me to start my own VC fund so that they can give me their money to invest for them. The only thing holding me back was it felt like a formidable challenge, and I didn't really know how to get started. Finally, I was motivated by a situation that most of you in the audience can probably have experienced as well. How many times have you been in a position where it was crystal clear to you, at least, what a friend, colleague, or family member should do, but they just couldn't see it. You offered sound advice, but they misunderstood. They didn't do everything you recommended, or they hesitated and ultimately failed to act. You can't force them to do it, and you can't do it for them. You're trying to help, but there's nothing more you can do. These situations are incredibly frustrating, and that's exactly how I felt as a relatively small investor on startups' cap tables. Forced to watch others make decisions and take actions that I recognized weren't optimal. My expertise untapped and my potential to contribute unfulfilled. I wasn't content being a mere spectator, bobbing around like a minnow in the sea, just along for the ride, when I knew I had the vision and expertise to chart my own course through an ocean of better opportunities. So, born out of a desire to lead, I decided to take control, to do things differently and better, with a winning multi-pronged strategy.
Amazing. And Giuseppe, how about you? Was there a moment or experience that kind of ignited your journey into VC?
Yeah, in my case, at the beginning, it wasn't gradual. I have to thank a crisis. I think it was Churchill who said that you should never let a good crisis go to waste. And in my case, it was the subprime one. I studied finance and I was set for a job in investment banking, but it was either that or management consulting in most of my class. But I graduated in 2008, and it was right in the middle of the subprime crisis, and that took a lot of shine off the those fancy jobs. So it prompted me to do some research, to look up alternatives. Back then, I graduated in Italy, so 2008. VC investing wasn't really a thing, wasn't really popular. But I happened to find a business angel network. I applied for an analyst position, got hired, and never looked back. Since then, it became gradual. I was fortunate enough to continue doing this job, accelerators, business angel networks, venture studios across different places. Hong Kong, in Europe, Southern Europe primarily, and the United States. And at some point, I also started investing in the community I was part of. So essentially expats, like people who happen to build their business in a country that is not the one they were born in. And that was, a gradual path towards starting my own firm. But at the beginning, it was really, I think I have to thank, I don't know if it's appropriate to say that for a global economic crisis, but in my case, it was a fortunate outcome, at least so far.
Terrific. Well, maybe we'll shift into talking a bit about some of the trends and shifts that are kind of taking place in the market at the moment, and how those might manifest in 25. So maybe Giuseppe, we could stick with you, and I'd love to hear about major trends or shifts that you're seeing, and how those might influence your investment strategies going into 2025.
Yeah, sure. So my feeling is that we're finally, hopefully, getting off kind of a sentiment roller coaster. We experienced the enthusiasm of the post-COVID rebound, low interest rate, free money, lots of capital flowing into VCs and startups, but also several 100 million plus post-money seed rounds. Many were great companies, and I'm not pointing fingers here, but at that point the math of VCs starts to crack. Then we also had 2022 climate cooling off, less capital, less exit, a bit of a funding crunch, and obviously, I'm sure my experience is anecdotal. I don't pretend not to make it a statistics, but it was the same for every other manager I spoke to. So lots of haircuts, down rounds, flat rounds, and essentially the priority became survival, getting to the next milestone, getting to the next round. Besides hyperinflation, wars, conflicts, so a pretty tough year. I'm not saying we're out of the weeds entirely, but from the perspective of the VC climate, I think that things are starting to become pretty balanced. I say this in terms of evaluations. I say this in terms of the timing to get into deals and to discuss the deals, not too slow, not too fast, from my perspective. There are no frenzies, but we're also in very exciting times. So lots of opportunities, lots of experimentation. So I think this is a pretty good spot at this point in time, and also since the scars and the burn of the recent difficulties is still pretty close. I find it's a good time to build productive relationships and make good investments.
Awesome. So if I'm hearing you correctly, in terms of investment strategy, it sounds like you're a little bit risk on, you're ready to be deploying cash, and you're pretty optimistic that this is a good time to be putting money to work. Yeah.
Yeah, I would say so. I mean, strategy-wise, it's not that given my my perspective on the context, which I think is fairly balanced. It's not that I have major major changes in the investment strategy per se. But yeah, maybe just a couple of things. Within the space of applied AI, you have lots of them. This is the excitement that I was talking about, quite an obvious one. I think you're still experiencing some competition in getting into deals, a little bit of FOMO to some extent. And this is justified in part, but you also have to tread carefully. You don't want to deploy too fast. This is, I think, this is the key, challenge, tension that we're experiencing. We see many exciting things, but this is a space that is changing in the span of weeks. So we are a relatively tiny firm. We're a micro VC, so we don't want to deploy too fast and risk losing a window that is, I think, is going to be open and relevant for quite some time. And the other thing is, as I said, the burns are still fresh. We're not out of the weeds, so I would say particular attention to runway when evaluating around making sure that we even if the enthusiasm doesn't last too long, the companies we invest in have the runway to achieve their next milestone.
Absolutely. Makes a lot of sense. And Robert, how about you? Any sort of major trends or shifts that you're seeing, and how might those affect your investment strategy going into 25?
I agree with Giuseppe. There are great opportunities all around the world. For what I invest in, I don't think the current market climate or trends are influencing my strategy. I invest in early stage, primarily seed, because that's where historically you get the best returns and the best risk-adjusted returns by far. Invest earlier in pre-seed, and it's way riskier because you're mainly investing in an idea and a hope that they can execute it someday. Invest later, the startup's already climbed up the hockey stick growth curve, so you missed out on its corresponding share price surge. It's at the seed stage where a savvy investor can really differentiate himself. Without question, later stage venture capital is significantly influenced by the macro environment. But to me, that's just noise to be ignored, having almost no bearing on whether one of my portfolio companies is kicking butt on the way to dominating the world. By the time my startup grows up to that size, the macro environment will have changed. So again, I invest in innovators that my partners and I can propel and help build into remarkable companies.
Amazing. Okay, so sounds like your strategy is not shifting much, and at the earliest stages, macro is not quite as much of influence as it might be, in later stages. Totally makes sense. So Robert, maybe we'll stick with you. Kind of adjacent question, but are there any specific innovations or markets that you think are kind of most promising or hold the most potential going into next year?
Yeah, I remain bullish on technology and healthcare, two of the largest and consistently growing sectors poised to continue to drive innovation and impact for years to come. In early stage venture investing, I'm not investing for next year, but for the next 3 to 6 years or more from now. AI will have a sometimes seismic effect on many specific use cases, most of which we humans can't even imagine yet. This makes it hard to forecast. The challenge in most cases is whether the innovation is protectable and defensible against competitors, whether the company can build a moat with a sustainable competitive advantage. I don't invest in the flavor of the moment that everyone else is chasing at overly inflated valuations, in my opinion. Instead, I try to focus on companies poised to create enduring value and achieve sustainable, substantial growth over the next 5 to 10 years.
Terrific. And Giuseppe, how about you? Any kind of specific innovations or markets you think are, most likely to explode going into 25?
Yeah. I mean, there are many, and absolutely with Robert. But from my perspective, mobility has always been a space I like, not just in terms of means of transportation, but more broadly how we think the urban environment and the cities of the future. But to be honest, this has been years in the making. It's not necessarily a new trend or space. If I had to point my finger at one that I believe is gonna experience a step change in 2025, it's education tech. This has been historically an area of focus for me, but it was always kind of niche, less sexy. By comparison, mobility is forecasted to get to $1 trillion by 2030 in the next 5 years. Education, as it stands now with the current assumptions, is a third of that, less than a third of that. The same applies to inflow of capital, revenue, number of companies, and so on and so forth. But I believe that these numbers are underestimating the impact of AI. And AI will have an impact on any industry, any space, and I'm not, educating anyone on that. But for education, I think this is gonna completely change the landscape, because we will need to rethink how we learn, relearn how to learn. And this is going to be true for not just for EdTech applied to schools. This is going to be true for universities. It's going to be true for corporate training, for essentially any aspect that entails some form of education or training content being delivered, the way we onboard employees and so on and so forth. So I think that will expand the amount of experimentation and the relevance of that sector for our society, and ultimately also for the entrepreneurial space, I think. So for 2025, that would be my. I'm hoping this is going to be the year of EdTech.
Yeah, great insights from both of you. Robert, did you have something you wanted to add?
No, fingers crossed.
Got it. Yeah, I agree with both of you. I mean, if I had to pick two sectors that I think are really just poised for, amazing opportunity and growth in 25, education and healthcare would certainly be top of mind. I actually recently saw a super interesting company, helping kids, I think as early as 2 years old, learn how to read. So there are really some like amazing things that are out there on the horizon. I've got a 5-month old at home, so education is definitely going to be top of mind for me soon. But awesome. Okay, so shifting gears a little bit, I'd love to ask you both, and maybe we'll start with you, Robert. When you're evaluating potential investments, are there indicators that signal a promising opportunity, and vice versa? Are there sort of red flags that might make you more cautious? Would love to hear your thoughts on both of those.
Sure. First and foremost, I always focus on what problem, need, or pain in the market does it solve? And then, are there specific target customers paying tons of money for the solution? That is, I try to evaluate the evidence. Has the startup nailed a scalable solution to the pain? Is it achieving product market fit or solution pain fit? If the answers aren't clear and the startup needs to learn how to do this better, I email them the name of a book or sometimes several to read. If they don't jump on that, buy, study, and follow the book's guidance, I write them off and move on. The same goes for the makeup of the startup's board of directors. After product market fit, the board is arguably the most important yet underappreciated factor in startup investment success versus failure. Crafting the optimal board of directors is the single best strategy to mitigate risks. Everyone should want a board of experienced experts covering each of the startup's key areas. Experts who help the management team to avoid big problems in the first place, or to react and pivot when necessary, who make better decisions and mentor and advise the CEO. If the startup doesn't seem open to adopting board best practices, that's a very bad warning sign. I focus on investing in innovators who are coachable, eager to learn, and want to partner with me and my team to build remarkable companies together.
Amazing. And any red flags that jump out to you that make you kind of extra cautious when looking at investment opportunities?
Those two things I said, if they don't have product market fit and aren't thinking about it and aren't worried about that, assuming that they have it, rather than having evidence proving that they do. And if they have the wrong reaction when I bring up the board and it's just them, just the founders, or the founder and his dad, or several people that are friends of the founder. In other words, stacking the board with the wrong kinds of people. That's a pretty bad sign.
Awesome. Awesome. And Giuseppe, how about you? Any, particular signals you're looking for that signal a really promising opportunity, and then vice versa, red flags that make you extra cautious?
Yeah, I'm gonna echo what Robert said. I operate at pre-seed mostly, so it's more about problem solution fit usually. But even more than that, it's a bit of a cliche to say that you invest in people in VC in general, in particular a pre-seed. But so obviously that's the thing where you can focus most in terms of actual due diligence, so to speak. So I think the positives are usually teams that are battle tested, that have been working together for years, possibly in a previous company that they founded. That's usually a good proxy for a stable relationship that will weather the difficulties of the next one. And on opposite end of the spectrum, rocky relationships are obviously a red flag. But again, to go back to the problem solution fit, I think the founder problem fit is also something I look at. It's you're gonna have to be in this for 10 plus years, hopefully, unless you're in the 2/3 that are gonna go bust before graduating to seed and Series A. But your commitment should be to tackling this problem for 10 plus years. So you have to be passionate about it. It's not just the market opportunity. Of course, there's nothing wrong with doing that. But people that have experienced that problem firsthand, that have scars or a personal agenda in fixing that issue, usually they come up with a sense of purpose, motivation, and most importantly, a deep understanding of the problem, which is encouraging in their likelihood of finding the right solution for that problem. So I would say that it's not that I review the curriculum or there is any analysis that can be done, but this is something that they're typically able to convey very effectively in the first 30 minutes when they feed it personally. So it's something I care about a lot. The lack of it, it's not a red flag, but it's definitely a sign of a promising relationship with them.
Love it, and agree with you. I think when a founder really understands their market, they're very clear in their messaging and succinct. So total agreement there. Great answer. So
Sam,
maybe
just one other point I wanted to sort of underscore about each of these things. I don't hold it against the founder or the management team if they don't have all these things figured out yet. Um, what's key is that they're interested in learning and figuring out and getting better. And so if I bring this topic up or recommend that they read a book or a white paper or something on the topic, and if they don't do that, or if after they do it, they don't actually sort of follow the advice to and try to get help to get better in these things, that's the red flag. That's a deal killer, because they're not able to grow and improve and surround themselves with people who hopefully know more about certain things than they do. Yes, they got to have founder market fit. They got to become the expert in the world on this topic, but they didn't start that way necessarily. They got to keep working at it to continually learn more.
I think that's a wonderful point, Robert. I've heard a great investor who kind of describes it as like, you're looking for lines and not dots, right? It's not about where the person's starting, but how quickly they can get to, where they need to be. So yeah, fantastic point. So maybe we can shift gears, talk about, there's a lot going on in the economy, right? We've got some major shifts. We've got a new administration coming in. Curious on a couple of things. Maybe we could start with, are there specific strategies either of you employ going into sort of more uncertain or volatile markets? Robert, happy to start with you if you want to take that.
I wouldn't say there's anything specific that I'd be doing. I'm not making any adjustments because frankly, I don't think I need to. I think I have a killer investment strategy and approach, and I'm investing not based on short-term economic fluctuations, which will inevitably change over time. I'm investing for the long term.
Totally agree and get it. Would you say though, in general, you're pretty positive going into 25 on, regardless of political stance, optimistic about, sort of regulatory changes and basic, kind of the economic macro, I guess, for VC going into 25?
Yes, absolutely. But even if there weren't this change in administration, I would also be. It was already a good environment. And again, we're making bets for things that are 5 to 10 years from now, right? The future. So short-term changes and the macro is just so far overhead, has almost nothing to do with early stage companies and their future prospects.
Yep. I agree with you, but also spoken like a true VC, there's never a bad time to be putting money to work, right? And Giuseppe, how about you? Any specific strategies you look at in terms of sort of mitigating risk going into uncertain or volatile markets?
I mean, the two things that I mentioned earlier, I think I agree that this is a relatively positive climate. I'm optimistic for 2025. I think all signs are converging towards a bullish market. It's even if the shifts in perceptions, maybe this administration is not going to be kind to, I don't know, clean tech, but I don't think that's going to have a negative impact on that. These are still strategic technologies that are still going to be supported, are still going to be relevant. We need those. So I can't really say that there is, a major, shadow cast on 2025. I think we have the good conditions to identify the right investments and place our bets. Still, I think we also need to learn our lessons, and the attention to resilience, to runways, or disciplined use of capital. It's important. I think it's important for the founders. I think it's important for us as managers, not to rush in the deployment of capital. Of course, we always have a vested interest in deploying. So you get to the threshold, and you can maybe start talking about the next fund. But I think that's legitimate. It's a fair temptation, but in this particular climate, I think you would risk missing out on a few opportunities, or over investing in a in a slice of the market. The technology is changing so quickly, and I'm talking about applied AI in general, not the foundational models, but the way these are used to reinvent so many industries, that you risk, essentially sampling too little of a technology innovation window. And therefore, the two things that I'm doing are ensuring on the startup side, ensuring that they are prepared for tough times, even if the climate is positive, and resisting the temptation to deploy too quickly, or in other words, trying to strike the right balance, ideally, between capturing opportunities right now. There's also an incentive on not waiting too much. Valuations are picking up again, but also not rushing into a space too quickly. So those are the two main things that would come to mind in terms of reacting to the current climate.
Perfect. Well, I really appreciate those insights. So just a reminder to everybody, we're going to do one more question, then get into Q&A. So please start, populating questions that you've got for either of our panelists, and we'll start addressing those momentarily. So in kind of closing out, obviously being VC Lab, we are an accelerator for emerging managers, which by default means we've got lots of VCs probably in the audience joining us today, and a lot of those folks are raising capital. I'd like to ask both of you, kind of reflecting on your own journeys, what advice would you offer to other VCs to sort of best position or align themselves with, likely LP priorities going into 2025? Robert, maybe we could start with you.
So my advice is, do not try to position your fund to align with LP's priorities, which may change year to year. Instead, follow Socrates, who said, know thyself, your strengths, your insight, your strategy, and your edge that will enable you to win. Communicate this clearly and confidently to LPs. As Shakespeare wrote in Hamlet, this above all, to thine own self be true. Your job as a venture capitalist includes maintaining integrity to your vision and approach, giving LPs a clear sense of your fund's long-term direction. Those LPs who believe in you and align with your strategy will naturally gravitate toward joining you as partners.
Love it. And Giuseppe, how about you? Any advice you'd have for other VCs in the fundraising process?
I mean, I wish I could give advice and have a recipe for closing LPs, but first of all, as an alumnus of VC Lab, I can definitely testify for the value of that program. And I think Mike Suprovici used to say something along the lines of, when the right LP meets the right GP with the right thesis, magic happens. And I believe this is true. It's not a science. It literally is art or magic. And you cannot and should not, I'm going to echo what Robert said, manufacture a strategy, trying to see if it sticks with some LPs. But there is a scientific approach to it. You should start from your key competences. It's same as what I said for the founder problem fit. It is exactly the same for you as a manager, and therefore you have to convey that the passion, the assets, the things that you bring to a specific thesis, a specific topic, sector, category of people. And on the other hand, cultivate your network and contributing paid forward, and like events show that you can add value to that space. And then if you do all of these things, again, it's not a fixed recipe, but then you increase your chances of finding the right match with the LP that has the same alignment. As a first time or emerging manager, that's what you need. You're going to need people that have the same sense of purpose, same ultimate goal. I mean, there's a lot of things, there's a lot of content that you can use to confirm their choice, their investment decision, but the conviction, they will probably mature it in the first 30 minutes of talking to you. So it's something that you should start. Again, I'm going to echo what Robert said, from you, and then in your passion and your focus, and then apply some discipline and do your homework to ensure that you cast the right net wide enough to increase the likelihood of making that match.
Well, really fantastic answers. So there's no magic bullet, folks, unfortunately. But it sounds like if you're true to yourself and you lean into your strengths, good things will happen, and cast a wide net. Okay, really fantastic answers. I appreciate it so much from both of you. So we're going to jump in now to Q&A. There's still time. If you've got a question for either of our panelists, feel free to put it in the chat. And by the way, you can also put it into the Q&A chat, rather. And you can also vote on questions as well. So feel free to do that. So maybe we'll start. Clement has a question that's directed to Robert, but maybe both of you could weigh in on this, which is, Robert, do you have any specific books that you recommend to founders? And I'll expand that to founders or other VCs.
Sure. I recommend this to anyone interested in business. So yes, it would be investors, because they need to understand what the founders should be doing. And the founders need to do this to achieve product market or solution to pain fit. The best book that I recommend as a starter is Nail It, Then Scale It. Nail It, Then Scale It. It's the best overview, the best place to start. It's a couple hundred pages. It's really a fun, interesting book filled with examples of companies that first struggled and then pivoted and figured this out and then reached huge success. There are additional books that are worth reading as a follow-up to it that go into more depth. And the best one in that category, so the second book after reading Nail It, Then Scale It, I'd recommend is by Steve Blank. And it came out in the same year, 2012. And it's more like a textbook. It goes into great depth. It's not a book you will read cover to cover. It's one where you pick and choose. First, you read the section that he says how to use this book, and then you follow his advice and dig into individual sections or chapters that are on topics that you need to go in much more depth on based on your experience so far. But you don't necessarily even have to get to read that book if you started with Nail It, Then Scale It.
Amazing. And is that book the 4 Steps to Epiphany?
Actually, I prefer, I don't know if we can see this, the Startup Owner's Manual.
Amazing.
The step-by-step guide to building a great company. Steve Blank, for those who don't know, he's considered the father of modern entrepreneurship. Terrific. And I've seen him talk, and he's great in person too.
Yes, also knows maybe more Silicon Valley history than anybody else.
Yeah, and then this was Nail It, Then Scale It.
Great recommendations. How about you, Giuseppe? Any favorite books that you recommend to founders or other investors?
Suggestions in terms of practical blueprints. I'm gonna go with a different take. Diversity. I loved Burn Rate from Andy Dunn, the founder of Bonobos. On I think the subtitle is something along the lines of building a company and losing my mind, and it talks about the stress and how important it is to think about your mental well-being in general, I would say, for any professional category, but in particular as an entrepreneur. As I said, like, luckily the climate is getting better, but it is still tough. It's lonely, and therefore I think it's a good complement to the great suggestions that just shared, also to know that you're not alone in this, and it's interesting to get that perspective from a very successful entrepreneur. So that would be my recommendation.
No, those are fantastic. I'll throw in one too of my favorites, which is The Hard Thing About Hard Things by Ben Horowitz. Another, classic. There are many in the genre, but yeah, really appreciate the recommendations there. Great question, Clement.
Can I throw one
Sure.
out there? Another one,
Please.
which is totally different, but I just finished reading it. The Power Law came out in
Great one.
2022. It's really a history of venture capital. Starts back in the 60s all the way up to 2022. And I think it's useful, certainly for a VC, but also for startups to understand the history and how it's gotten to where it is. I mean, it includes angel investors, it includes accelerators, it includes growth funds, at all different stages. So even though I've been in this profession for a long time, I learned a lot from reading the book. And it's a useful perspective to understand, regardless of what side of the table you're sitting on. The Power Law.
Yeah, I second that. That's a great one. Okay, well, maybe we'll move on. So Emil has a question. Could you talk about the LP appetite to deploy capital into the VC asset class, given the DPI drought currently experienced by LPs? So I'll let either of you feel free to take that first, and then we can pass it over to the other person if they've got a couple of things to add.
Giuseppe?
Sure. Yeah. I mean, I think I don't want to sound as a broken record, but I think that people who raised in 2020, 2021 probably had. I don't think fundraising is ever easy, but of course there was a lot of enthusiasm. You could a lot of appetite. Then 2022, obviously a big crunch. Now it's fairly balanced. Of course, some of the challenges that the asset class is facing are still definitely there. The IPO and the M&A market has cooled off a little bit. Therefore, it makes it hard to distribute. It puts a lot of pressure on GPs and LPs alike, ultimately. So to provide a specific answer, of course, the DPI draft is a thing. Raising now, I think you are in a position to start from a blank slate. There is a case, I believe, to art. You can build a case on the fact that historically, if you look at the cycles of the IPOs, they can hardly last for more than 2 or 3 years. So this should change, regardless of administrations and political stances. So if you raise now and start to deploy in the coming months, I think you can make a case for ideally better DPIs in the future. Of course, that you're going to need to invest in the right companies and provide those returns. But if the companies do their job, if you do your job as a manager, DPIs will increase. The constraint remains in the sense that if there is no liquidity going out, previous funds, existing funds, some LPs will be a bit more hesitant to deploy additional capital. So as I said, we're not entirely out of the weeds, but that again, you should think for yourself. So what you can do is make the case for the factors that are gonna mitigate this difficulty in the future. If people, I think there is enough capital, there is appetite on the asset class, and I feel like I wish it was the fault of other VC funds, but when LP refuses to invest in our fund, talking about poor DPI performances, I think it's probably a polite way to deflect a critique to our ability to convince them. So it's definitely to provide a specific answer to the question. I think the appetite is there. That metric is still top of mind, of course, but it's not, I think, a barrier to deployment per se.
Um, I'll just add a couple of points. One is, I think it's a mistake to call it one asset class, venture capital. It's late stage is totally different than early stage. And so to me, this seems to be a factor that's affecting late stage because they can't get IPOs. But less than 1% of all startups are going to do IPOs. So almost all of them are going to get acquired. So if you're investing in an early stage company that grows well, it's going to have hopefully many potential acquirers want to acquire them, regardless of whether there are IPOs happening or not. So that's one thing. Secondly, um, I think investors should be learning from the best other investors in the world, like the endowments, like Yale Investments, their track record over a couple of decades, beating the pants off everybody else. And they have fully 25% of their entire portfolio in venture capital. Why? Because it's a better return and it's better risk-adjusted return, and they're investing for the long term. Every investor should be investing for the really long term, like through their retirement accounts. So it really should be an issue of reallocating their existing assets to be properly spread, diversified across the different asset classes. Venture capital, and I've done a report on this, an analysis, to find what are the experts in all the different fields, the investment banks, financial, advisors, professors in academia, et cetera. And I made a chart about this, and every one of them, independently through their own research, are modeling out what's the ideal asset allocation. And they all come up with for high net worths, for ultra high net worths, and for institutions, including pension funds, that they should be somewhere between 25 and 50% in alternative investments. That's a big category, which includes private equity, hedge funds, real estate, and venture capital. So work with your advisors, figure out what percentage you want into different asset classes, but don't treat VC as one big thing. Look at the difference. Early stage venture capital has a way higher return than everything else by far, like 30% per year as an industry for early stage, compared to 14% for late stage VC and private equity, and 10% for publicly traded stocks, et cetera. So long-term investors should all be rebalancing their portfolios, investing for the next 10 years, and not be reliant on returns from the prior investments they made, but keep making more bets, just like Yale and all the other top performing investors have done for decades.
Amazing. So, Robert, so maybe following on to that question, when it asks something adjacent, which is, you started alluding to, I think, IRR. We were talking before about DPI. So, Wen's question is, DPI, IRR, MOIC, right? What are the performance metrics that you find are most important to LPs as you're fundraising?
I think that question's best directed at LPs to poll them and say overall, what are they looking at? In my experience, showing that you're getting MOIC along the way, making progress, that you invested in something 10 months ago and it's already gone up 2.5x, like that gains momentum, and people want to increase their investments that they already made into your fund, and then they tell their friends. So I feel like as long as you're making progress along the way, and then ultimately you do have to return capital to investors. So telling them that, hey, in 10 years, this is really going to pay off, that's not good enough. So I try to focus on companies that are going to actually produce returns to our LPs and us way sooner than that. But you still want to see that they're going to perform well into the long-term future, because whoever's going to acquire them cares about that. So that's why I say, like, I try to look at, I'm investing for 5 to 10 years in the future. hoping that some of them will actually have returns to us sooner, but that just means we'll get a higher valuation from the acquirer because it's going to keep making them a lot more money in the decades ahead.
Got it. And Giuseppe, how about you? Are there any particular performance metrics that you've seen, LPs really latch onto, most?
No, I would say the same. It depends. Like existing LPs, prospect LPs, like is this are they interested in a time relevant metric or no? So it depends on the stage of the conversation, the type of person you're talking to. I wouldn't be able to point a single one. I mean, yes, probably the easiest one to use is MOIC. It's something that you can apply also to a single specific investment that you made as an angel. It's the most versatile, I would say. But I wouldn't single it out. It's different things at different times, I think.
Makes sense. Okay, so I think we've got time for one more question. And it's a good one. So breaking into venture capital is challenging. This is a question from Clement again. Breaking into venture capital is challenging. What's the best advice that you could offer to somebody who wants to, run and start their own fund? Maybe Robert, we can pass it over to you.
Well, I certainly appreciate our hosts, but I'm not saying it because of them. But you should apply and join VC Lab. They really have a lot of experience and expertise in this, having launched, successfully over 550 VC firms over the years, and trust their expertise and guidance. Do everything they say. Don't think that you know more about this than they do. Trust yourself, as I said before, in your actual investments you make, but in terms of launching a fund, unless you've done it before, how would you know? Where would you go to get this help? As far as I know, there's no other place that provides this kind of help to a first-time or emerging fund manager. So that'd be my my clear answer.
Obviously, that is the correct answer.
And they did not pay me to say that. I honestly believe it. If you see on social media, I posted a thing about them. I think it's just an outstanding program.
Yeah, well, that's very kind and great to hear. Giuseppe, any other advice that you would have for new managers?
Plus one to that, I would say, maybe as an addition, the program is great. It's also intense. So the recommendation would be to get your duck in a row before getting into the program, because it's lots of subsequent sprints. And like for me personally, I had to reactivate a lot of people in my network. And in some instances, I didn't even realize the value that was there. I should have done probably a better job in cultivating it and grooming that network. So going back to the previous question, I think you need to have a decent degree of clarity on what is it that you want to do, what you're passionate about. Then the program will supply the framework to weaponize it, to take action on it. And of course, you're going to need to change a lot of them, unlearn a lot of things that you that you believe you know, that you have learned. But having that clarity and being prepared to take action, I think it's going to maximize your chances of success going through the program.
All right. Well, that was a really fantastic, answer from both of you, and we were not paying them to say this, but
exactly.
Yeah, and
I can give you my address.
Yeah. Well, I just want to thank both of our panelists, Robert and Giuseppe. Really fantastic. I know, as an angel investor and LP, I'm super optimistic going into 2025. Really a lot of the trends that we discussed today, resonate with me. I'm sure with a lot of you in the audience, and also really appreciate the insights that you've both offered to other fund managers in the audience, on sort of positioning themselves or not positioning themselves to going into fundraising with LPs. So thank you both so much. This was a really fantastic session. We always love feedback if you've got that. But otherwise, we will see you next time. And again, thank you both so much.
Thank you,
My
Sam.
pleasure.
Thank you, Sam, for leading this.
Thank you.
Absolutely. All right, folks, have a great one. Bye.
Bye.